Data analytics software company Palantir had their first earnings report as publicly listed company for the third quarter ending September 30, 2020, in which the company had reported a revenue growth of 52% year-over-year on 289.4 million revenue compared to 2019 of the same period where it has a $190.5 million. They also had increased their revenue guidance for the full year of 2020 at the range of 1.07 billion, up 44% year-over-year compared to last year's $743 million. Folks, it shows to us that this 17-year-old data analytics company has been growing, closing new contracts, and had benefited with their three-phase business models. In the 3 months ended September 30, 2020, they closed 15 deals with new and existing customers, each worth $5 million or more in total contract value, including U.S. Army for $91 million, National Institutes of Health for $36 million, and the renewal of their aerospace customer amounting $300 million. Palantir revenue growth and revenue guidance looks attractive. That is, if not because of their stock-based compensation, they would have entered into a positive territory. That is, they could have 73.1 million of net income from operations. In fact, this stock-based compensation caused their gross margin to decrease from 68% last year for 9 months ended September 30 down to 63% this year of the same period, in which it had $120,285,000 classified as cost of revenue. Worth noting as well, Palantir had increased their operating expenses by 100%, oh my God, from $775 million in 2019. They incurred $1.5 billion in 2020, in which $1 billion is stock-based compensation. Yes, stock-based compensation for Palantir creates a red flag to me, although this stock options to employees as a form of motivation or rewards to hard-working employees and to their executives for meeting certain targets. However, the question here is until when they will give this much of stock options. $1 billion to me is very high for a stock-based compensation expense. It is fine if your purpose is to motivate your employees, but it has to be reasonable as well, not to the extent that it could dilute investors' interest. Nobody had asked this one during the earnings call, so let's wait on the years or months to come on the plans of management on how to stop or what would be their plans with regards to employee stock options. Silver lining though to owning this stock is their strong balance sheet, as it has $1.8 billion of cash and cash equivalents for total current liabilities of $942 million. That is, it has a current ratio of 2.54, which is ideal compared to an average of 2:1. Total ratio is 1.93, while debt-to-equity ratio is 1:1. Palantir growth is inevitable as they position themselves for government contracts, for government services, and private contracts right now. Also, they are going to invest more on their direct sales force, continue to build out their products just like their Apollo to continue build their operating leverage. Palantir has price consensus of $13.17 on 6 analysts, with Jefferies Financial Group having the highest price target of $18, who says that despite the stock's recent surge, Palantir has more room for further upside driven by combination of estimated revisions and more incremental multiple expansion. Palantir is being owned by 116 institutional investors, comprising 10.10% of its total outstanding shares per Fintel.io, including BlackRock Inc. owning 29.29 million shares, Canada Pension Plan of 24.16 million shares, and Morgan Stanley for 3 million shares. So with that being said, is Palantir stock a buy after this Q3 earnings report? My opinion to this stock have not changed since its IPO. I'm one of the lucky investors or individual investors who had able to snatch the share at $10, though my mistake was not able to load up at its dip below $9. However, I had increased my position from 30 units to 150 units, holding it long-term or until my price target of $79, using their enterprise value over revenue compared to Microsoft. Meeting it will represent me earning 639% upside for my cost base of $10.68. I still believe that buying this stock at current price of below $20 is a strong buy with limited downside, as support level as of today looks like at mid $15. Hence, buying this stock is like buying a Microsoft or Oracle at their early stage of trading. That's all for today, guys. So if you like this video, please give me this one, not this one. And also, do not forget your subscribe button and your notification bell so you'll be keep updated on my upcoming videos. Please remember that I'm dropping a video once or twice a week.